Financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
All right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride. We got a good show lined up for you today. Today, as you can see from the title, Sell in May and Go Away, ? You know, actually, this is episode number 436. And it seems like a couple of years ago, we actually did a podcast very similar to this, where we were talking right here at the end of April. I believe it was in 2021. We were talking about the seasonal investing approach. You know, so there's this old adage in the stock market, sell in May and go away. And the reason that people say that is because it's a very popular investment strategy. I don't necessarily think that it's something that everybody should do. I don't think that it's always accurate. In fact, history shows that it's not. But what it is it's a popular investment strategy that suggests that investors should sell their stocks in May and invest in other assets until the end of October. It's also known as the Halloween strategy because after October is over, then what is known as the best 6 months of stock market performance begins. That begins at the very beginning of November. So the strategy is based upon the idea that the stock market tends to underperform during the summer months. You might have heard that called the summer doldrums, while the period from November to April typically generates the highest returns. And we've actually done teachings on this for our members. We've done, coaching courses and things along those lines. We call it the 6-month switching strategy. And it's quite interesting. It's really based upon just seasonal investing. And seasonal stock investing is a type of investment strategy where investors buy and sell stocks based upon the time of year. The strategy uses historical patterns in the stock market to determine which stocks tend to perform well during which certain period. So people take, all manner of approaches to this strategy. It's pretty interesting. And I want to talk a bit more about it. But the reason why we're talking about it is because at least you should know this. If you're a trader or an investor out there, it's easy to forget, whenever we head into May that there's quite a few investors who will just step away. They'll actually sell and they'll move out of the market for the summer. This is actually a very popular strategy. It doesn't mean that you should. It doesn't mean that I'm going to. It just means that everybody should be aware of it. If you're an investor out there, you just got to know that the people are going to sell stocks in May, that they just literally do at the beginning of May. And this idea was actually popularized by the Stock Traders Almanac, run by Jeffrey Hirsch, who was started by Jeffrey's father. And that's published annually. If you've never checked out the Stock Traders Almanac, it's pretty cool. It provides key information on cycles and trends and patterns that I've always found very helpful. But anyway, in his book, in that Traders Almanac, Jeffrey Hirsch, basically shows the incredible outperformance of the market over time, like going back to 1950. And you'll see that, say, for example, and I'm looking here at one of the tables in his almanac that shows from the average Dow Jones performance going back to 1950 all the way up to about 2018. That during the November to April time period, that best 6 months, so to speak, the average performance of the Dow Jones was 7.5% as far as the total return. But then when you go and you look at the May to October timeframe, the worst 6 months, that average performance going back to 1950 is a mere 0.6%. I mean, so it's dramatic. It's dramatic. In fact, there's another table in the almanac that shows this ridiculous comparison that shows if you had invested $10,000 into the Dow Jones in 1950 and only stayed in the market from November to April and then sold out every May and then got back in every single November and sold in May, and it just kept doing it over and over from 1950 all the way to 2018. Your $10,000 would have turned into $1 million, about $1.1 million or so. However, this is pretty ridiculous. However, if you took that $10,000 and you invested it into the Dow Jones at the beginning of May, and then you sold every October, your $10,000 would be turned into $1,000 from 1950 to 2018. Now, that's actually hard data. It's hard to believe, but it's actually hard data. So this really shows you the dramatic underperformance of the overall worst 6 months, from May to October. Even when you look at the drawdowns since 1980, the max drawdown on the best 6 months of the stock market, going from May to October, the max drawdown is about 35%. And the longest drawdown period was about 45 months. Whereas if you go to the worst 6 months, then you find out that the max drawdown was 55% and the longest drawdown period was about 74 months. So it's pretty dramatic. And you'll see this across, many metrics. Many different research outfits have proven this, that the best 6 month period for the stock market, typically, not always, and remember, nothing's foolproof here, but from November to April, the average return somewhere between 7 and 8% on average, and about 77% of the time, you're going to be higher during that period. Whereas if you go from May to October, it's usually around 1%. So during that whole 6 month period. So May to October is really the worst time, historically speaking, based on seasonality. Now, that's not always the case. I mean, you can go back and you can see that there are certain times whenever, investing during that summer time, those summer months, and even into the early fall is not a big deal. In fact, it's actually good. So you don't necessarily have to have stocks fall off of a cliff or just totally underperform during this poor 6 month period. Nevertheless, history is pretty interesting on this point, and the patterns are pretty strong, that show. So if you're interested in the 6 month switching strategy, the way that it works is you buy stocks on the first trading day of November, at the open, and you sell any fixed income holdings, and you just get into stocks. And then the way that it works is then at the end of that period, at the very first trading day of May, you exit stocks at the open, and then you buy fixed income holdings like bonds, So that's how it works. People have been doing that for quite a long time. And, so just be advised, that right now we're moving into that time where many people will do that. They'll step out of stocks and move into bonds. Now, there's already people who are very, very ambivalent on the stock market right now because of all the uncertainty. So in addition to this sell in May and go away strategy, I want you to know about that because, here we go. We move right into this time. It's the same thing in November where you don't want to be caught off guard because oftentimes people will then start piling back into the market to be a part of what they often consider to be the Santa Claus rally, or as we move into the later parts of the year. And that's when spending picks up. That's whenever we see spending, accelerate. And, the reason is because, seasonal trends. We often have the holiday season. People are spending more money. They're kind of getting back in the groove of the things after a summertime, kind of, checking out. So November is that time when people really begin to get back into the market. May is when many of them will just sell and go away, right? So you just don't want to be caught off guard by that. You want to be aware. But again, it doesn't mean that we're going to see a big broad sell-off whenever May comes. It doesn't mean that. In fact, often it doesn't mean that at all. But there's so much uncertainty in the market, and people are scared. I mean, it's really quite something whenever you think about all the uncertainty that's in the market, and the market's always crawling a wall of worry. On the other side of this very short break, I want to come back and talk about some of the market uncertainty that is driving a lot of the fear here in 2023. I want to talk about interest rates, debt ceiling, banking sector crisis, recession fears. Let's talk about that in just a minute. Friends, So there's just tons of uncertainty in the market right now. And it's really like this a lot. I mean, it's not really uncommon. If you're new to stock trading, and many people are new because in investing, many people got in the wake of the COVID crisis. We saw a huge influx of new traders and investors in 2021 as the Fed was just spitting out money and, printing money like crazy, the government mailing out checks. People were like, well, I guess I'll invest this money. Some people made some decisions to do that. Well, the market, went straight up. And then, of course, 2022 was just brutal. We had this incredible sell-off that we haven't seen the likes of in a very long time. So now we're living in the wake of that. Now we're in 2023. We've just been put through the ringer, over the last 2 or 3 years or 3 or 4 years. It's been really tough. The economy has had to weather all manner of crises. We've had the war going on between Russia and Ukraine and the supply chain constraints that created. We had the inflation created by the Federal Reserve and all of the excessive fiscal spending that was going on to fight COVID. And then we also had, many other things, the 0% interest rates and all of this, which was driving a lot of demand. And then the Fed, as we well know, really misstepped. I mean, they really made a big misstep. And they said they were going to tackle inflation whenever, but they were going to let it run hot for a little bit. It got out of control. And then they had to begin aggressively fighting it. And quite frankly, the U.S. economy is not really built for high interest rates. We're based on cheap money here in the United States. If you don't have cheap money, if you don't have low taxes, if you don't have cheap energy costs, if everything isn't low, people start, complaining. And so everything is built upon cheap. You need cheap money to run this economy. And so, we're running now at 5% federal funds rate, near 5%. And the Fed is going to be meeting next week to supposedly raise the interest rate by another 25 basis points. So let's talk about that first. That's the interest rate uncertainty. We got interest rate uncertainty. I want to talk about debt ceiling uncertainty. We got, recession uncertainty. And then, of course, we have the banking sector uncertainty. There's a lot of uncertainty right now in 2023. And what I want to suggest to you is that despite all of this, and I want to drill down into these, but no matter what all of this uncertainty is, what I want to encourage you to do is to not change your plan based upon all of these uncertainties. If you're saving for retirement, if you're out there listening to me today and you're, in your working years, you're 20, 30, 40 years old, even 50 years old, and you're saving for your retirement, you shouldn't, in my opinion, now this is my humble opinion, you do what you need to do, you talk to your financial advisor, you figure out what's right for you. But in my opinion, one of the worst things that you can do to your retirement is to alter your investing strategy and stop it even based upon near-term uncertainty, right? Because otherwise, you're going to always have some uncertainty that's going to give you pause as to why you should keep investing, right? Now, when I say investing, I know many people, when they say investing, they mean, all into stocks. Well, I'm certainly not that way. 1/5 of well, actually, it's a little bit higher right now because the stock market has come down. But personally, 1/5 to 1/4 of my investment dollars will go towards the stock market. So we're talking about the stock market today, with sell in May and go away. But that's not where I'm putting all of my investment dollars, and neither do I think you should. I think everyone needs to have a balanced approach. In my case, I do some real estate, and in fact, that's the largest portion of my investment strategy. I also do some stocks. I do some hard assets. I do cryptocurrency. I invest in my own businesses, reinvest in my own businesses. So there's a lot going on there. It's not just stocks and bonds, right? So you really want to have a diverse approach, I believe, when it comes to investing. But my point is that you don't want to allow uncertainty about interest rates or debt ceiling or recession or whatever to become the determining factor of whether you're going to invest. Like that would be the wrong way, in my opinion, to discern what's happening and to react to what's happening, right? So there's lots of uncertainty, but I don't believe that anyone should allow the uncertainty to cause them to pause their investing strategy for the long term, because your future self is depending upon what you're doing right now. If you're not convinced of that, talk to somebody who undersaved and is now in retirement. I've certainly coached and mentored many people over the years who have reached that place where they're in retirement and they didn't save enough. They didn't invest enough. They didn't realize how important it was until it was a little too late. And, they can recover. There's always ways that they can recover. They can start, habits, good habits then. But I'm encouraging you now to not let the noise and the uncertainty deter you from your long-term investing strategy, right? Really important. So you can allow the noise and the media, and especially if you get on social media and you start listening to all their quote-unquote expert advice, that's for free, by the way, you're likely to get seized up or paralyzed or paralysis by analysis or whatever. And you don't want that to happen. You don't want that to happen. You don't want to underinvest for your future self. Your future self is going to need those dollars invested now, right? It's going to need time for those things to grow. And as I mentioned, not just stocks. Stocks are just a little part of the overall investing picture. There's other things that you want to continue to invest in. But when it comes to stocks, it's really the same way. Either be in the market or don't. If you're going to be in the market, then realize it's going to go up and down. I mean, this is the reality of it, right? And if you're not ready for that, if you're like, well, it has to go up only, and if it doesn't go up only, I'm not, well, then don't invest. Then don't invest in stocks, But don't have unrealistic expectations. That's the thing. So if you're going to invest in stocks, just know that guess what? It's going to go up and it's going to go down, right? But over time, all things being equal, because we live in an inflationary environment, asset prices tend to go up, not down, over time. Right? Now, how long will it stay that way? Well, your guess is as good as mine, right? We know at some point the game of musical chairs will come to an end, undoubtedly, okay? But that does not mean that it's going to come to an end now or before you retire. And the way that you can really insulate yourself from that potentially happening before you retire is by being diversified, but not simply by not investing. I mean, that's certainly not going to solve it, right? So you can't solve your future problems by not investing. So you have to invest. The question becomes, what are you investing in, and how much are you investing, and what's your overall goal? What's your overall aim? Okay. So anyway, we could spend a lot of time on that, but let's talk about uncertainty here. So we have interest rate uncertainty. So people are concerned about where the interest rates are going to be. And if you listen to the forecasts and the analysts, I mean, it's wide-ranging kinds of predictions. Some people saying that interest rates are going to stay high and elevated for a very long time, okay? Others, like myself, suggest that we're going to go back to pre-COVID interest rate levels, as early as, say, 2024, 2025. Okay, so let me just provide you what I think is going to happen on interest rates. This is, my opinion is worth 2 cents. I mean, who knows what's going to happen tomorrow? I mean, I can't even tell you what's going to happen tomorrow, let alone what's going to happen 6 months from now. But this is my best guess. So right now, the interest rate that the Fed has set, the federal funds rate, is hanging at around 5%, somewhere around there. And that's really their top terminal rate. They're shooting for one more 25 basis point increase at next week's meeting. That seems to be the consensus. Well, once they have done that, once they have raised that interest rate by 25 basis points, the consensus is that the Fed is then going to announce a pause in their rate hike cycle. This seems to be the top terminal rate that they're getting ready to do. They're going to raise it to the terminal rate, and then they're going to pause. In my opinion, the rate cuts, so the pause could last through the summer, but then the first rate cut could be as early as September. September seems like it could be the very first month, based upon our analysis, where you could begin to see the Fed cut. And they could start with a little trim of, say, 25 basis point cut, okay? And then they may do that over the course of a few months. So they're going to begin easing the interest rates. Now, this is one of the very best times to be an investor, is when the Fed has jacked rates up and then begins to cut them. Because this is all the Fed does, by the way. Their bag of tricks is pretty small. I mean, they raise rates and they cut rates. I mean, there's discount rates and there's other things that they can do, but and reserve requirement ratios and all of this. But the main thing here is that they're raising the federal funds rate, and then they're going to cut the federal funds rate. And when they cut the rate, well, it provides a tailwind, right, for asset prices. And it begins to what they call monetary easing. And so it begins to ease financial conditions. So this is actually good. So you certainly don't want to miss that aspect of the market as the Fed begins to ease. Now, some people are convinced that the Fed is not going to be able to cut rates because of inflation. Our argument, my argument here, is that the United States economy is built atop a need, it basically has an implicit need for cheap money. So the Fed may want to keep interest rates at 5% for 5 years, but look what is already happening to the banking sector, right? Look what they've done to the banking sector by their aggressive rate hikes. They've caused all manner of turmoil in banking balance sheets. And so the Fed knows that it's sort of screwed the pooch here, right? It's got to unwind its mess. It's got to get back to a place where interest rates are at a more sustainable level. And 5% interest rates at the Fed level is unfortunately unsustainable for the United States economy. Okay, that's just not something that they can maintain. So this is their medicine. They've given the United States economy the medicine that they believe that they need to give to it. They've administered it. Now they're going to pause, and then they're going to start cutting rates back to a more sustainable level. Will we get back to 0% interest rates? Well, eventually, right? The next crisis, they'll move interest rates back to zero. And who knows when that'll be. But we will certainly begin to see interest rates begin to move down as we move into the latter part of 2024 and certainly by, latter part of this year, 2023, and then into 2024, certainly. And by 2025, you probably have some normalized interest rate levels. So there's a lot of interest rate uncertainty, but our belief is that we're going to begin seeing rate cuts as early, it could be as early as September of this year, but certainly by the end of the year, we would begin to see the easing begin in our mind. Now, it's not just interest rate uncertainty that's driving a lot of concern, but you also have debt ceiling uncertainty. Now, unlike the interest rate uncertainty, the debt ceiling uncertainty is largely a manifestation of political and media smoke and mirrors. The fact is that the debt ceiling itself is the borrowing cap. And raising the debt ceiling, by the way, doesn't raise spending by itself. What it does is it provides the Treasury with the authority to make payments on obligations that have already been incurred. That is paying for things that the government has already spent or has decided to spend, right? And so you may think back to, say, 2011, where Congress waited until the very last minute underneath the Barack Obama administration, which led S&P, by the way, to issue its first ever downgrade of U.S. debt. That was a big deal. But the debt ceiling is the total amount of the money that the U.S. government is authorized to borrow to pay for programs like Social Security, Medicare, military salaries, tax credits, and on and on. The debt ceiling has been raised 100 plus times since 1940. And it doesn't matter who is in office. It doesn't matter who is in the White House. The U.S. has seen several Republican and several Democratic administrations since the 1980s. And no matter who is in the White House, the U.S. debt has been rising steadily throughout the years. Now, the corporate media, which tends to either slant left or right, tries to portray this as not being the case, right? And it really is good for ratings for them to get you to tune back in, bite your nails and say, will the politicians actually agree to actually pay for Social Security? Will they agree to keep military salaries? Will they cut Social Security recipients off? Okay, this is all, quite frankly, in my opinion, nonsense. And the fact that, of course, they're going to continue paying for these things. Because if the U.S. defaults on the debt willingly, just to own the libs or just to own the Republicans or whatever the thinking is, well, then the dollar is going to lose significant value. And interest rates will, shoot up sharply. I mean, incredibly. And not only that, you would have credit markets globally facing severe repercussions, right? You would have gold and commodities rallying. You would have a whole bunch of wild things happening, and evaluating other securities would become much more complicated. I don't see the Republicans deciding to not raise the debt ceiling. In fact, we've already had the House leader, Speaker of the House, Kevin McCarthy, admit that the debt ceiling must be raised. So it's really just a matter of what's going to happen. The GOP is claiming that it wants spending cuts suddenly. This is a new phenomenon. And then the President Biden wants a clean increase is what he's demanding. So what should be cut, right? What should be cut? And what's interesting is that nobody seems to want anything cut. And I'll tell you what I think should be cut. If the Republicans are serious about reducing spending, I think they can offer to cut congressional pay and benefits. Huh? Why don't we do that? If they offer that, they'll be serious about reducing government spending, huh? Where else could we cut? Well, we could begin with the largest line item in the U.S. federal budget. How about the unaccountable Pentagon's $850 billion budget? Huh? Never passed an audit. And yet the GOP, will they dare to cut into America's war machine? Or would they rather cut benefits for low-income families than to cut this $850 billion budget that's given to the Pentagon with no strings attached, no accountability? This institution cannot even pass a simple audit. They don't know where trillions of dollars are, right? And yet there seems to be hardly any discussion about looking and examining the federal budget, specifically when it comes to what we're going to give to the Pentagon. So there's plenty of places to cut. There's lots of fat in the budget. And hopefully we will get some common sense that reigns here when it comes to the spending cuts. The U.S. debt limit's supposed to be reached by June, and without action, the United States will default on its debt. We expect that there will be a last-minute debt ceiling deal, just the way there has been in the past. So as far as uncertainty on the debt ceiling, we think it's more smoke and mirrors designed by the media to kind of keep you tuning back in, clutching your pearls, making you wonder what's going to happen. But in reality, we know what's going to happen. They're going to raise the debt ceiling and keep borrowing money in order to keep the thing afloat. That's how United States does business. And so that's what they're going to keep doing. Okay, so interest rate uncertainty, we're not too terribly uncertain on that. We have some ideas. We've laid them out. Debt ceiling uncertainty, we're not too terribly uncertain about that. We have a feeling that the United States is going to keep borrowing money. So we're not too uncertain about this. What about a recession? This has been the most telegraphed recession in my lifetime. I have never heard more people talk about how a recession is coming than what we have now. And so the idea that a recession has come or is coming or will come, that's already baked into the cake. Okay, so if a recession suddenly comes tomorrow, then guess what? Everybody is expecting it. Recessions, when they're not expected, actually are more dangerous. When you are expecting a recession to the point where we are now, where stocks got crushed expecting the recession, well, these are much less severe because you've already baked them into the cake. A recession is already baked into the cake. The investors are expecting a recession. So if you get a recession, well, then it's not really going to be as bad as some might expect because we've already expected the recession to come. I mean, undoubtedly, we got big problems, right? We're not downplaying the problems. We have a national debt that's over, nearly $32 trillion. We have unfunded obligations out the wazoo. We got, big problems. And the debt is projected to rise in relation to GDP over the next 30 years and to grow even larger, as we move on and move forward. The CBO, Congressional Budget Office, has projected that the federal debt held by the public is going to reach 185% of GDP by 2052. Neither party has a solution for this. Neither party is working hard and diligently to figure out how to solve this, right? CBO also expects federal deficits are projected to nearly triple over the next 30 years. It's outrageous. Okay, it's outrageous. The net interest outlays alone are expected to quadruple as a percentage of GDP over the next 30 years, according to the CBO. And if you look at 2024, the fiscal budget that's been proposed by the president is $6.8 trillion. $6.8 trillion, right? Leaving us with another massive $1 trillion plus, deficit. So as we move forward, we certainly expect to see a recession possibly arrive. But when you look at the earnings, for example, like we just got some latest earnings from big tech like Microsoft. Microsoft is actually raising its growth forecasts as it heads out into the end of the year. So the big tech earnings are not quite bearing out the fears that some have about consumer spending. Consumer spending, although it has been stunted in some ways, especially in some retail aspects, overall, the consumer is more resilient than many people had expected. This is actually good news because it moves us from a bad expectation to a less bad expectation. And that's oftentimes a very positive development. So as we look forward, we undoubtedly see slower economic growth. We see that interest rates are the U.S. economy's Achilles heel, and therefore they're going to have to bring those down. And, so we certainly look out and we see a lot of problems. But when it comes to the recession, it's already baked into the cake. So we're not too terribly excited about a recession causing some sort of unforeseen event. There are always black swan events that you can't foresee. And barring one of those, again, we're not too terribly concerned about a recession. Now, again, things could change, but as things stand now, that's what we're seeing. And then also there's some banking sector uncertainty. So Moody's downgraded the U.S. banking sector to negative back on March 14th. And that was a pretty negative blow. We've seen some continuing roiling of the financial sector because of the higher interest rates. And I want to stress that this is not like the 2007 and 2008 situation that we had, where we had the banks going under because of their shenanigans and because they were playing fast and loose with depositor money, where you had the Dodd-Frank bill that passed, and then you had all of these safeguards that were put in. If you look at the banking sector in the United States today, despite what's going on now, you'll see that it's healthier than it was back in 2007 and 2008, all things being equal. The problem that we have in the banking sector right now is largely due, and in fact almost entirely due, except for a few extraneous things, to the rapid interest rate increase that we saw from the Fed. Don't forget that the Federal Reserve raised interest rates from nearly zero to nearly 5% over the course of a year, a little bit more than a year. And so we're talking about a 5,000% increase in the federal funds rate in a very short amount of time. No one has seen this. I mean, this is radical. This is very radical. You have to go back a long time to see anything like this. And so that really, really messed up some balance sheets in the banking system, right? Where, and I don't want to get into all the nerdy details about what that means for bank balance sheets. But the point is that has created a lot of turmoil in the banking industry. And so as the Fed begins to unwind the interest rate levels, that's also going to help the banking sector. But what's really happened here is that we've had some of the regional banks and the smaller banks that have really suffered the most, whereas the bigger banks now are kind of using this as an opportunity to benefit from consolidation of the industry, industry consolidation. So, as far as the banking sector goes, I would say still remains to be an outstanding question mark. You could still have more fallout there. I'm not too terribly concerned about a recession because it's already been baked into the cake, and everybody and their dog is expecting a recession. Okay, so that's not typically how recessions become problematic. It's when people are not expecting them. The debt ceiling, I'm not too terribly concerned about this. I believe that they're going to remedy it, maybe even last minute details, and it'll be good for media ratings. And that's really what it's about. And then as far as interest rate uncertainty, I'm not terribly concerned that the Fed is going to leave interest rates at high levels because America is built upon cheap money. The entire economy depends upon it. And if the Fed doesn't deliver and begin to provide cheap money, they're going to be blamed for everything. And they are not interested in that. They prefer not to get any attention, quite frankly. So these are some of the things that are outstanding. These are some of the uncertainties that we see, but many of them I think are overblown, and which is why I believe that we will end the year higher, both on the S&P 500 and also on the price of gold. And I also think that Bitcoin is going to move much higher throughout the end of the year, especially as the market begins to discern that interest rates will begin to go down. Remember, the stock market is a voting machine in the near term. It's a weighing machine in the long term, but in the near term, it's kind of like a popularity contest. And the stock market is going to be looking forward about 6 months. And once it knows that the Fed is beginning to pause, it's going to start pricing in those rate cuts ahead of time. And you're going to start seeing prices or values of asset prices go up, in my opinion. So kind of key takeaway here as we bring this podcast episode to a close is don't base your investing upon all of the potential uncertainties that could happen in the near future. Instead, keep your long-term investing strategy intact. Don't stop investing. No matter what, the media is saying, no matter what that they're trying to spook you with, your future self is depending upon you having long-term investing strategy intact and not stopping. So you've got to keep going. Don't let the media, don't let the social media, don't let the quote-unquote experts convince you to stop investing in high-quality assets, right? You just don't want to listen to that. You've got to prepare for what's ahead. You can certainly go put your money in a tin can and go throw it in the backyard, bury it in the backyard, but that's not going to be a very happy day for your retirement self whenever it comes time to open up that can. So you've got to invest. You've got to do something. And don't let the media dissuade you from practicing good investing habits and doing it habitually. All right, friends. Well, that brings us to the end of today's program. I sure hope you enjoyed today's broadcast. I sure did, and I sure do appreciate you tuning in each and every time we do our podcast right here at followthemoney.com. And as always, I'd like to leave you with a final word, this time by the great Walt Disney, when he said, "The way to get started is to quit talking and begin doing." And that's just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted